Everybody is the wrong side.
Okay, we're going to talk about that in just a second. That is a simple example of a more general principle. The stocks you want to look at, if you're not going to be a specialist, are stocks that are obscure. So ideally, you're the only one looking at them. Small companies in faraway places. But most important, look really bad. They are undesirable, where you as an investor look at that opportunity, whether it's because this is a time where everybody thinks things are falling apart, or this is an industry that's in real trouble, or this is a company that's in real trouble, and you look at that and you say, oh, I'm not investing in that. And when you see that, that's actually where the opportunities are. It is obscure, ugly, sometimes other supply and demand imbalances, but cheap stocks that you want to do. Portfolios simply that consist of the 10% of cheapest stocks on any stock exchange in any extended period in the United States and in almost every country but Italy, and it's reassuring that it doesn't work in Italy, outperform the overall market, depending on how often you trade those portfolios and so on, by between 3 and 6%. And you can do it just by statistically applying that test, calculating a ratio of market value for the company to its book value and picking the lowest market to book ratios. And that will do phenomenally, not every year, but over time that will do phenomenally. Now, it's interesting what those portfolios look like. 2/3 of those stocks go bankrupt. But the ones that don't do so well that those portfolios significantly outperform the market. At the high end, if you buy expensive stocks that are attractive, that have compelling growth opportunities, they underperform the market by significant amounts, a little less, not quite the 3 to 6%, maybe 2 to 4%. If you do a long-short portfolio, it's the best portfolio. It makes about 1% a month with no net market exposure. And that's just applying these principles in practice. And the question is, why is it that we think that this has worked and has worked for as many years as it has? And the answer increasingly has come to be that it is taking advantage of systematic human misbehavior that most investors just cannot help themselves but reproduce. So, and I think there are probably 3 elements you want to concentrate on here. There's a whole field of behavioral finance that documents these, but there are probably 3 that really matter. The first is that in every society we know of, lotteries have been successful enterprises. People buy lottery tickets. They have always been mathematically really crappy investments. Worse when the government does it than when the mafia does it, but in any case, you lose between 30 and 70% of your money. Yet persistently people buy lottery tickets. Why? Because people will overpay for the dream and the opportunity to get rich quickly. In markets, that means they will overpay for the glamour stocks where they think that's a possibility. So on the one hand, you have that, which leads to overvaluation of the glamour stocks. If you simply avoided them, you'd actually improve your return above the market average. Second thing is that people, and the technical name for this is loss aversion, people don't like looking at ugly opportunities with high probabilities of loss. They just don't like looking at it. And if they don't look at it carefully, they're not going to buy it. That means that the ugly stocks are going to be oversold. They're going to be sold, so the person on the other side of that trade is just dumping it. And you can get a really good price. And that, of course, complements, with an E, the lottery ticket effect. Now, what actually amplifies these 2 things in terms of individual behavior is human beings are constituted and cannot stop themselves from believing they know what they know with a vastly higher degree of certainty than is warranted. In the debate on weapons of mass destruction in Iraq, nobody said there are weapons of mass destruction in Iraq with probability 60% or probability 40%, but that was the reality. In advance, nobody knew. They all decided either that there were for certain or there weren't. When they apply that to stocks, they decide the good stocks are good stocks for certain, and the bad stocks are bad stocks for certain, and nothing is certain. Now, this kind of behavior is so compelling that I'll just tell you one of the experiments that you'll see people cannot help themselves. So one of the seminal experiments in this area of overconfidence is people were asked to look through eye holes into a dark room at luminous squares. And they were told the squares were between 1 foot and 20 feet away from them. And they were simply asked to estimate how far away the squares were and to put error brackets on their estimates. What the psychologists didn't tell them is they had a complete set of squares from that big to that big that they chose at random. And the answers that people gave were completely uncorrelated, as they should be, with where the squares actually were. The right answer should be 10.5 feet plus or minus 9.5 feet. Everybody gave a very precise answer. They said, oh, that's 14 feet away, that's 6 feet away, that's 5 feet away. And the error brackets they gave were plus or minus a foot. So in a situation of radical uncertainty, people impose certainty on that situation. And you can see how that's going to amplify the overvaluation of the glamour stocks and amplify the undervaluation of the ugly stocks. The other thing you ought to know is people don't learn. These experimenters decided that maybe they didn't understand that there were squares of different sizes. So they actually showed them the squares of different sizes, and they reran the experiment. And people still gave very precise answers about where the square was. They were still completely uncorrelated with where the square was. And the error brackets went up from plus or minus a foot to plus or minus 2 feet. People learn a little, but they don't learn much. And those individual behaviors are things you can take advantage of systematically, and you do when you buy the ugly undervalued stocks and portfolios of those stocks and stay away from the overvalued glamour stocks. Now, you would think that institutions might act to control these individual irrational behaviors. All the evidence is that they amplify them. If you're a portfolio manager and you underperform the market, it turns out your clients will stick with you if you don't underperform by that much. So if everybody else is buying the glamour stocks, what's the low-risk thing for institutions to do? Buy the glamour stocks yourselves. When you're marketing, what these companies talk about is their big successes, their lottery tickets. And you can't get those if you don't buy the lottery ticket stocks. They never talk about the near bankrupt stock that came back from death. So for marketing purposes, they tend to put together portfolios that appeal to those instincts, and they concentrate on trying to get blockbusters that they can talk about. So all the evidence we have is that institutional behavior amplifies this individual behavior. So in terms of a search strategy, it's either specialization or cheap, ugly, and unappealing and obscure, or both. And ask yourself how many investors actually do that, and the answer is vanishingly small.